Welcome to this Handtech Markets video on swing trading. Most traders are familiar with trend-following trading strategies and longer-term buy and hold trading strategies. These generally seek to profit by trading in one direction only. In contrast to this, swing traders are happy to take either long or short positions and will often switch from one to the other as prices advance and decline within a longer-term trend. As you can see on this chart, the long-term downward trend is made up of multiple upswings and downswings. The total distance travelled by price as it navigates each of these swings is far greater than the straight line change in price from A to B. This gives the swing trader an opportunity to extract greater profits from the market than a trader with a long-term trend-following strategy. There are many ways to trade the short-term swings in price. One of the most basic is to use simple bar chart analysis, looking for classic signs of change in near-term price direction. This may involve a break in a series of higher highs and higher lows when an upward trend is failing, or a break in a series of lower highs and lower lows when a downward trend is failing. Price gaps or extreme price moves that are not confirmed on the close may also provide clues to an imminent swing in prices. Candlestick patterns are also useful for detecting short-term price swings. Individual candles and small patterns made up of just 2 or 3 candles often provide relatively reliable reversal signals that can be exploited by swing traders. On this chart, you can see multiple candlestick signals, including an inverted hammer, signaling a swing from an upward trend to a downward one, doji candles, reflecting indecision in the market, and 3 white soldiers, indicating the emergence of a firm upward trend. There are also numerous candles with long shadows that suggest prices have been rejected. For more information on this topic, see our candlesticks video. Technical indicators derived from price action can also be used by swing traders. Here we see an example that uses a simple moving average crossover system. Using this technique, a swing trader will always hold a position in the market. When the faster moving average is above the slower moving average, the trader will hold a long position. When the faster moving average crosses below the slower moving average, the long position is switched out for a short position. This method can work well with extended swings, but could result in very choppy and potentially unprofitable trade when prices are consolidating sideways. On this particular chart, we have plotted an 8-period moving average and a 21-period moving average, both of which are Fibonacci numbers. You'll need to try out different combinations to find a setting that suits you. Swing traders may also find it useful to use an oscillator such as the Relative Strength Index to help determine when a trend is turning from one direction to another. Using the default settings, the market is considered to be moving into overbought territory once the RSI rises above 70. On the other hand, when the RSI drops below 30, the market is said to be moving into oversold territory. When combined with signs of divergence, this can be a very powerful tool. One improvement that some traders use involves shifting the overbought and oversold levels depending on the phase of the underlying trend. For example, if the broader underlying trend is bullish, the overbought level is increased to 80, while the oversold level is lifted to 40. By the same token, if the underlying trend is bearish, the overbought level would be dropped to 60, with the oversold level lowered to 20. Finally, another tool that swing traders might find useful is the Parabolic stop and reverse. Again, this is a tool that will result in the trader always holding a position in the market. When one position is stopped out, another is opened in the opposite direction. On this chart, the Parabolic stop and reverse levels are represented by the red dots. The dots sit below prices when a long position is held, and above prices when a short position is held. The Parabolic stop and reverse takes account of both price and time, with the use of an acceleration factor in its calculation accounting for the parabolic shape of the stop and reverse levels, which move progressively closer to the current prices as time passes. You can learn more about this indicator by clicking on Help in the main menu, then selecting Help Topics to open up the user guide. Then in the left-hand column, click on Analytics, open the Technical Indicators subfolder, and scroll down until you find the Parabolic stop and reverse. Given the rapid changes in foreign exchange prices, it's a market that frequently provides opportunity for swing traders. The techniques for swing trading outlined in this video barely scratch the surface of those that can be used, but they may provide a useful place to start. Good luck.